Hello and welcome, everybody. If you sat across from a European fund right now, a serious one, 2 years past Series A, for example, building something that could plausibly become a global technology leader, and you ask her where the system breaks for her specifically, she would not name fragmentation. She would not name talent. She would name the round she's about to raise, the growth round. The Series B that has to be larger than what most European funds can lead. The Series C has to be supported by follow-on participations she cannot count on from her early stage cap table. The pre-IPO round that, increasingly, will not be priced by European institutional investors at all. This is where the scale-up gap lives operationally. In episode 1, we looked at the macro picture. 4 of the world's top 50 technology companies are European, and the bottleneck is not founder talent. In episode 2, we looked at fragmentation. Cross-border deals in Europe close 3 to 5 times slower than US deals. Both of those are necessary. Neither is sufficient. In this episode, we go inside the capital architecture itself, and my argument is this: Europe does not lack capital. Europe lacks a capital architecture that can move capital from innovation to scale. This is Jörn Menninger, Joe Manager. This is Startup Radio. Let's build this carefully. Act 1, 2 financial systems, not one capital supply gap. Start with the observation that should organize everything else in this episode. The United States does not simply invest more capital into startups than Europe. It operates an entirely different financial architecture. That distinction matters. If Europe simply has less capital, the problem is solvable with subsidies, with public funding, with whatever lever moves stock. If Europe has a different architecture, the levers are upstream. They are slower. They are politically harder. The data points to the second. US companies have historically financed growth through capital markets. Equity heavy, institutional investor intensive. Built around the assumption that long duration technology risk is a normalized asset class. Pension funds, insurer, university endowments, sovereign pools, they all allocate meaningfully to venture and growth equity as a standard part of a diversified portfolio. European companies, by contrast, have historically financed growth through banks, bank loans, debt-oriented, collateralized, conservative. The European banking system is one of the most sophisticated in the world. It financed Germany's industrial rise. It supports the Mittelstand. It underwrites the export champions that still produce a significant share of Europe's output. Europe's financial system was designed to finance industrial continuity, not hyperscaling technology platforms. When you understand that, you stop being surprised that the system produces the outcomes it produces. Act 2. The institutional capital sits upstream. Now look, one layer upstream. The deepest difference between European and US venture capital markets is not at the venture layer at all. It sits upstream in institutional capital allocation. In the United States, the LP, limited partner base, for venture funds is dominated by institutional capital. Think public pension funds, corporate pensions, insurance companies, university endowments, family offices, sovereign wealth funds. They all treat venture as a normalized asset class. They allocate consistently. They re-up across vintages. They provide the long-duration capital that allows venture funds to be large, sustained, and capable of supporting portfolio companies through multiple growth modes. In Europe, that pattern is structurally different. European pension funds allocate a small fraction of their assets under management to European venture capital. This is not because European households lack savings. It is the opposite. EU households actually hold a greater share of their wealth in cash and highly liquid assets than US households, around 30% versus 12%. The wealth exists. It simply does not flow towards venture as an asset class. There are reasons for that. Some are regulatory. Solvency II, pronounced Solvency II, shapes how European insurers handle long-duration risk. Pension fiduciary norms in many European jurisdictions are conservative by design for legitimate reasons related to protecting beneficiary outcomes. Some are cultural. Venture has historically been categorized in European institutional asset allocation as alternative, illiquid, and high risk, a designation that legitimately constrains exposure but also locks in a small allocation as the default. The European issue is not capital formation in absolute terms. It is institutional willingness to absorb long-duration technology risk. And once you understand that, you understand why the mega fund gap exists. Fund size follows institutional participation. A general partner can only raise a fund as large as the LP base will support. If the institutional LP base is structurally thinner, the funds will be structurally smaller, and that smaller fund size will determine everything downstream. Between 2013 and 2023, there were 137 venture capital funds larger than $1 billion, yes, would it be, dollars in the United States. In the European Union, there were 11 versus 137. That number is not the problem itself. It's a symptom of the upstream allocation pattern that produces it. Mega fund scarcity and the Series B problem. That symptom matters because of where the scale-up gap actually emerges operationally. At seed and Series A, European founders can access competitive funding. The early stage ecosystem has genuinely improved over the past decade. Again, in Europe, the early stage ecosystem has genuinely improved over the past decade. That's important to note. But the funds are smaller than US peers. But for early rounds, that is not the binding constraint. You can write 5 million euro Series A from a 200 million euro fund without difficulty. The constraint begins at Series B. A Series B that needs to be 50 to 100 million euros requires a fund that can lead it. A Series C that needs to be 150 to 300 million euros requires a fund that can lead it and reserve follow-up for Series D, for example. By the time a company is raising a pre-IPO round in the 4 to 800 million euro range, the universe of European funds that can credibly lead is small, and the universe that can sustain pro rata participation through scaling is smaller still. The result is what makes the European investment banks scale-up gap finding concrete. By year 10, European scale-ups raised 50% less capital than San Francisco peers. That gap does not open at seed. It compounds at every growth round. Because at every growth round, the European cap table includes early-stage funds that cannot defend their position and must accept dilution as US crossover capital comes in. European investors often help build companies they ultimately cannot afford to keep. That is the specific mechanism behind the headline numbers. It is not that European venture is absent from the cap table. It is that European venture cannot hold its position as a company scales. Control migrates. Ownership migrates. Listings migrate. And the system produces a consistent output. Companies created in Europe scale with mixed European and US capital exited predominantly on US markets. Act 4, dry powder, is not deployment. There's a comforting counter-argument that needs to be addressed directly. If you read aggregate European venture statistics, you can see a figure that has become common in industry commentary. It's called dry powder. capital committed to European venture funds, but not yet deployed. The figure is large. It suggests at first glance that the European system is well capitalized, that the problem is somewhere else. That reading misunderstands what dry powder measures. Dry powder is a stock figure. It tells you how much capital has been committed and is sitting available. It does not tell you whether the capital can be deployed efficiently across the stages where it is needed. A fund can hold significant dry powder and still be unable to lead a 100 million euro round because its fund size and reserve allocation structurally limit the check size at any given stage. KfW's venture capital barometer makes the picture concrete for Germany. The data shows early stage activity is stabilizing. Capital is reaching seed and Series A rounds. Awesome. While growth stage deployment remains weaker than in pure markets. The capital is there in aggregate. It is not deployed at stages where European companies need it most. Professor Dr. Fritzi Köhler-Geib, chief economist at KfW, has been precise about this distinction in our conversation with her. The diagnostic question is not whether stored capital exists. The diagnostic question is whether that capital reaches the stage where competitive outcomes are decided. In Europe, increasingly, the answer is that it does not, at least not at the scale required. Dry powder tells us capital exists. It does not tell us whether that capital reaches a stage where competitive outcomes are decided. That distinction is more important than it sounds because it explains why public commentary about Europe being well capitalized, pointing, for example, at the dry powder numbers, does not contradict the EIB finding. Both that can be true at once. Stored capacity high, deployment efficiency low. The architecture has friction at the stages that matter most. Act 5. Capital Markets Union is keystone. This brings us to the upstream reform that everything else depends on. The Capital Markets Union. The Capital Markets Union, usually shorter to CMU, is the European Commission long-running initiative to deepen integration across European capital markets. The intent is structurally correct. A unified European capital market would improve liquidity, deepen institutional participation, increase scaling finance, and reduce the fragmentation that currently makes cross-border investments expensive. But progress has been slow. The political coordination required is significant. Member states have legitimate but conflicting incentives around national financial sectors, around tax policy, around the role of national stock exchanges. And the cost of slow progress is not what most commentary suggests. The common framing is that without CMU, European companies have to list abroad. That is the visible symptom. Upstream, a weak exit market depresses venture returns. Depressed venture returns weaken LP willingness to allocate to venture as an asset class. Weakened LP allocation keeps fund sizes small. Small fund sizes limit follow-on capacity. Limited follow-on capacity produces the ownership migration that further weakens the exit markets. And the cycle compounds. A weak exit market does not merely affect exits. It weakens the entire venture financing cycle. That is why CMU is not an add-on. It's a keystone. The fragmentation reforms we examined in episode 2, the 28th regime, EU scale, addresses one layer of that friction stack. They are necessary. They are not sufficient. Without integrated public markets capable of absorbing large European technology listings, the venture capital remains structurally weaker than its US counterparts at every stage upstream. The Draghi report on European competitiveness made the case for treating CMU as the central economic reform of the decade. The latter report on the future of the single market reached convergent conclusions. The institutional consensus is clearer than the actual political will to execute on it. That asymmetry between diagnostic clarity and execution capacity is itself the diagnostic. Act 6. Germany illustrates the contradiction. I want to close this episode with, of course, Germany, because Germany illustrates the contradiction more clearly than any other European market. Germany has world-class engineering, world-class technical universities, world-class industrial depth, a research pipeline that is globally competitive. Startup formation has materially improved. Germany ranks 5th in the world in unicorn count. The early stage ecosystem is functional. What Germany does not yet have is a capital market capable of retaining ownership of its most successful technology companies through the full scaling cycle. The German model is internationally coherent. The Mittelstand logic, specialized, globally competitive, resilient mid-cap firms, has produced durable economic strength for decades. In my conversation with Thomas Jatzombeck, Parliamentary State Secretary for Digital and State Modernization, he made the case for that model directly, because the technology companies now being built that will define global infrastructure for the next, let's say, 20 years are not specialized mid-caps. They are AI systems, compute platforms, foundational software layers. They require capital at a scale, intensity, and speed that the historical German architecture was not designed to provide. Germany successfully built an early stage ecosystem. What it has not yet built is a capital market capable of retaining ownership of its most successful companies through the full scaling cycle. That is the contradiction. It is not unique to Germany. Synthesis, capital architecture, not capital supply. Here is where we land. Europe's scale-up gap is not merely a startup problem. It is not merely a founder problem. It is not merely a venture capital problem. It is a capital architecture problem. The European system produces innovation. It does not consistently compound that innovation into platform scale dominance. The mechanism is architectural. Institutional LP allocation patterns keep fund sizes small. Small fund sizes constrain follow-on capacity. Follow-on weakness drives ownership migration. Ownership migration depresses exit market returns. Exit weaknesses closes the loop back to institutional allocation. Every link in that chain is repairable in principle. None of them are easy to repair in practice. Meanwhile, the cycle that requires this architecture is accelerating. AI infrastructure, compute platforms, and next-generation technology increasingly reward scale, speed, capital intensity, and market depth. Capital flows towards systems capable of absorbing it efficiently. Today, that system is still not Europe. Europe does not lack capital. Europe lacks a capital architecture that can move capital from innovation to scale. If the architecture does not evolve, the outcome is predictable. Europe will continue to build excellent companies. It will continue to lose them at the moment of maximum capital requirement. And the dependency the Draghi report described will continue to deepen. Not because of a single failure, but because the architecture is doing what it is designed to do. The hidden champion model, again, is not a failure. The question is whether it is still sufficient. Let's look a little bit into the next episode. In the next episode of this series, we move from the supply side of capital to demand side, procurement. European procurement systems, particularly public procurement, systematically disadvantage startups and scale-ups. The compliance complexity, the reference requirements, the risk aversion of public buyers, the fragmentation of procurement across member states, they create a demand-side weakness that mirrors the capital-side weakness we just have examined. A capital system can be repaired, but capital flows toward demand. If Europe cannot create domestic scaling demand for its own technology companies, the capital architecture problem cannot be solved by financial reform alone. That is the question we examine in episode 4. This is Jörn Menninger, Joe Menninger for Startup Radio, Europe's voice on startups, venture capital, and innovation. I'll be back next week. Until then.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io.
Remember, sharing is caring.